Let's go ahead and book transactions that involve our bank account and reconcile our bank account for the month of October. So here it is, our statement. Let's go to reconciliation. Right, make sure we select the correct one, 1031, good. Enter the balance. Let's see, service fees. Yes, we have $25 fee. Good. All right, again, let's show in our debit and credit window what is being debited, what is being credited, remind ourselves. So our bank account will be reduced by $25, right? Because they're going to charge us. And our expense account is going to go up. So here it is. Even though we're entering it once, it is still double entry accounting. And this $25 is both a debit and a credit, right? It's a debit to this expense account, $61,600, bank service charges. And at the same time, it's a credit to our bank account because it's being reduced. Bank account is an asset. Assets are reduced through credit. So here it is. Let's go on and continue with our reconciliation. All right, so we see a couple of things right now are showing up in the reconciliation window. We have our $25 charge right here, good to go. And we have the bank payment that we paid our credit card. So here it is. We can charge, mark that one. Okay, the rest we still got a book. So let's get our deposits going first. So we know that all of these deposits are sales, so we can book them as a lump sum, and we know that they're summed up right here very conveniently for us on the statement. So let's get going with that one using our general journal entry. We don't need to use our debit and credit window to explain it because debits and credits are right here. How cool is that? When we book lump sum, we'll use the end of the month, the end of the statement date, so 1031. Again, deposits October. All right, good. So what's happening? We know one thing for a fact, our bank account balance increased. Bank account is an asset. Assets are increased through debits. So we can just take this lump sum right here. Oops. All right, so those are deposits for October. All right, sales are going up too. We know sales and revenue accounts are increased through credits. Makes sense, right? Our sales go up, and therefore we take the money and we put them in the bank, and our bank amount balance goes up as well. So bank account is an asset. It's increased through debits, and then sales revenues increased through credit. So here it is. That would book our deposits. So save and close. See, it's showing up right here. We can mark this one and then just mark all of this one. We know all of them are sales. If it was different, we would have to segment it, okay? So we're going to do that, for example, for our draws. We know that these three withdrawals are all draws. We're taking money out of our business, right, to spend on our personal. And therefore, we're going to book that, again, as a lump sum, end of the month. Draws October, right? So we know one thing for sure, what's happening. Bank account will be reduced because we're taking money out of our bank account, right? Bank account is reduced through credit. And with the cool part about QuickBooks, we can just add it all right here. Here it is, right? So that's our October draws. All right. And then what else we know? We know that our member draw account will be decreased. Again, I know it's kind of counterintuitive. We cover it at the end of the year, but members draw account technically is an equity account, right? And equity is reduced through debit. So what is happening? We reduce our equity, our ownership in the company. Why? Because we're taking money out of the company. Makes sense, right? We take money out for our personal use. This money is no longer in the company, and therefore our ownership is reduced by the same amount our equity is reduced. So here it is. Save and close, right? So here they are. We're going to mark those off. What else we have? We have merchant fees, and then we have three of our checks, right? So let's go ahead and book checks. All right. So these ones we'll book individually because the offsetting expense accounts are different. All right. So again, let's start with the simple. We know that bank account will be reduced. But now we need the invoice or receipt to find out how do we essentially apply these charges. So let's look for it. Here it is, right? So that's for our utilities. Right, we can put our invoice number in here. So here it is, saving new. Our next check is right here, 29. Again, let's start with basic. We know bank account will be reduced. But now we need to know what expenses, right? So let's look for 29. Here it is. That's our cleaning. All right, we can put the invoice number in here for future reference. All right, see, debits and credits are in balance. Bank is an asset, it's reduced, it's being credited. Bank account is an asset, and then expense, the 6,400 cleaning supplies is increased, it's debited. Again, one more check. Here it is. All right, again, we know bank account will be reduced. We know that much. Oops, a little too much, right? And then we need the invoice to know what accounts will be impacted. So here it is. It's one of those where we have multiple expense accounts. So let's get looking at it. So we have our rent for 1,000. Again, let's put the invoice number in here. All right. What else we have? We have insurance. We have dues and subscriptions. We have maintenance. And we have advertising and promotion. So here it is, right? Debits and credits are in balance. Expenses go up when debited, so all of these expense accounts will increase. And bank account is an asset, and it's reduced when it's credited, right? So save and close. You see those three checks right here. So let's go ahead and reconcile those. Here we are, and we still off. We're still off by $238.03, and that's our merchant account fee. Good. So let's go ahead and book that one, right? That one is pretty straightforward. Right. We know that, again, our bank account will be reduced by that amount. They took that money out. All right, and we know that our merchant account expense will go up. So here it is, expenses go up when debited, assets go down when credited, our bank balance will be reduced by this amount, and our expenses on merchant account fees will increase by this amount. So here we are, save and close. We have it right here. Do we get a 0? Yes, we do. That's our objective. We completed reconciliation. All right, let's take a look at the reports. Our ending balance matches. Good. We would print it and attach it to the statement. Let's take a look at this one. Yes, our deposit match, even though it's a lump sum. And then let's take a look at the other ones. Everything seems to align. Good. We would print it, attach it to the statement, and we are good to go. So we have booked everything off the statement while we were in reconciliation mode. That is a very fast way to do it. And again, as long as you reconcile and everything matches, you did it correctly.